And financials are where we kick things off today. My next guest says he's bullish on the big banks, especially Goldman Sachs. We'll talk to Charlie Babrinskoy, Vice Chair and Head of the Investment Group at Ariel. Also with us, let's bring in Frances Donald. She's Global Chief Economist at Manulife Investment Management. And if I'm not mistaken, out with a recession call today, Frances. That's not going to help bank shares.
No, it isn't. But you know what? I get asked all the time, do you see a recession or no recession? Yes, we do have 2 quarters of negative GDP and an uptick in the unemployment rate. But I just don't think this 2-world recession, no recession story is really going to help investors, especially over the next 6 months. I actually think, even though I do think there's going to be a recession, that for the next month or two, you could have a pretty sanguine macro environment, inflation coming down, growth still strong, the Fed backing up. Don't conflate the economists with the strategists out there. Some of us have both roles. Sometimes those roles diverge.
Yes, it's fun that you can wear both hats because that's helpful right now. What's been the change for you? I know time when we've been revising up current quarter or last quarter GDP. Why are you now looking ahead and seeing more declines?
It's the rates, Kelly. Those rates, history might not repeat this time, but it's going to rhyme. We really have trouble throwing out all of the standard economic relationships with rates moving this high, credit contracting at the speed and the magnitude that it is right now. The consumer is out of excess savings. Defaults, delinquencies higher, and a housing market that is effectively completely frozen. We can't get the growth to come above 0%. But again, I think the focus here needs to be not just on, do you have 2 quarters of negative GDP, but where is the momentum for growth moving forward? And I think even though there might be some disparity in recession or no recession calls, you're going to find just about everyone has trouble arguing that growth is going to re-accelerate from this point forward. So the focus, whether you want to believe in that mathematical output or not, is going to be lower growth moving forward and a Fed that eventually gets to pivot.
Let me bring in Charlie on that note. He's on the newsline. Charlie, I know you're not a big fan of macro calls and you've generally been constructive, but what's your take on what's going to happen here in the next 6 months or so?
We think we're getting near the end of this cycle. We think the end of the tunnel is in sight and it's not an oncoming train. We think inflation is heading towards the number. It's not going to get there quickly at 2%. We've told you that for a long time. The Fed was optimistic that it could get there, and that wasn't right. But inflation has come down. It's getting down to an acceptable level. And at this point, with all that's going on in the world, the Fed is not going to want to be adding to trouble. So we do think the end is in sight. When they signal to the market that they are done raising and the next move will be a cut, that will be perceived as very good news by the market, and we will finally get an end to this headwind that we clearly have had in housing.
Although, Charlie, if I'm not mistaken, isn't there some track record for stocks to underperform after the last hike when people kind of realize, okay, the recession is coming? Have we ever had the end of a tightening cycle where we didn't have a recession onsetting?
Well, we're hoping this is going to be that case. I think there is a very good case that if in the next 3 months we get the Fed signaling that they're cutting rates, not because there was a recession, but because we have made enough progress on inflation and because they don't want to add to instability in the world, I think we could get a cut without a recession, and that would be a very good environment, particularly for more cyclical stocks.
Frances, anything you'd add to that?
Well, I'm in agreement on that trade. The next couple of months, I would trade the soft landing narrative for sure, but I wouldn't conflate the short term with the long term. With the price level shock that we've seen in the past couple of years, I don't think you get those rate cuts unless you see the unemployment rate start to rise. We think that happens in January and February, and that's going to be enough for the Fed to actually cut by mid-year. But this doesn't seem like a Fed to me that will cut without the recession. And I think that's one reason why saying that a recession is necessarily the most bearish outcome, I don't think that's the case. A soft landing, stagflation type of environment where you get no growth and no Fed cuts, that's worse for most investors than a short-term recession where you get the Fed pivot.